If you're buying Bitcoin today, it's still early. I don't think it's too late. So if you have zero exposure to Bitcoin and you feel like you missed it, 95% of investors have zero Bitcoin exposure. So you're still way ahead if you're buying Bitcoin today. If you look at Bitcoin wallets, comparing it to the internet, we're back to 1996 levels. Internet went exponential from 1996. So it's still the earliest days. When I started on Wall Street in the 90s, that's also what I heard on Wall Street. I remember our economists and our bond heads of fixed income saying the US is on an unsustainable path for debt, and that was 35 years ago. So for the next 35 years, you're going to hear the same thing. The US is on an unsustainable path of debt, yet it's probably not going to make a difference.
Every once in a generation, a technology emerges that's so disruptive, it changes everything, even if most people can't see it yet. In the 1990s, that technology was the internet. Today, it's Bitcoin and the broader world of crypto. And according to Fundstrat's Tom Lee, we're still incredibly early, not just in terms of price, but in terms of adoption, infrastructure, and potential impact. Back in 1996, only a tiny fraction of the world was online. The internet was slow, expensive, and hard to use. But behind the scenes, exponential growth was brewing. User adoption began to soar, developers built new protocols and platforms, and suddenly, what seemed like a fringe technology became the backbone of global commerce and communication. Amazon was founded in 1994. Google showed up in 1998. By 2006, the internet was indispensable. Now, look at Bitcoin. Despite being over a decade old, more than 95% of investors still have zero exposure. Wallet growth, on-chain activity, and institutional infrastructure are expanding, but we're still at the ground floor. Just like the early web, crypto today is clunky, controversial, and constantly misunderstood. But for long-term thinkers, those who can zoom out and see the arc of history, this is an inflection point. Tom Lee believes that if you're buying Bitcoin now, you haven't missed the boat. You're actually front-running the next major wave of adoption, one that could rival or even surpass the internet boom in terms of wealth creation. And this isn't just about price speculation. It's about the transformation of money, trust, and global financial systems. But Lee's bullish thesis doesn't stop at crypto. In a recent wide-ranging interview, he also addresses some of the most pressing macroeconomic concerns. A 20% market crash triggered by Tariff Liberation Day, recession fears pushed by mainstream economists, and a Federal Reserve still trying to navigate post-COVID inflation with outdated tools. While many investors panicked earlier this year, Lee stayed the course. And now, with stocks staging a sharp V-shaped recovery, he believes the worst is behind us. He also breaks down why the Fed may have misjudged inflation caused by tariffs, why interest rates could fall sharply in 2026, and how that shift might benefit not just equities, but crypto as well. Because when liquidity returns and real yields fall, risk assets tend to soar, and in this cycle, digital assets like Bitcoin and Ethereum are no longer on the fringe. They're part of the conversation. So if you're wondering where the markets are heading, how to position yourself, and whether crypto still offers asymmetric upside, this conversation with Tom Lee is one you don't want to miss. Please watch, share, and like this video. Subscribe to the channel and turn on post notifications for more insightful analysis. Thanks, and enjoy the video. Bitcoin is consolidating, and for serious investors, that means opportunity. While most people are just buying and holding, there's a smarter way to grow your Bitcoin stack, earning it daily through mining. No trading, no guessing. Just consistent Bitcoin income. And I found a platform that makes it incredibly easy. It's called Gets Mine, and I've been testing it myself. Think of it like buying a Bitcoin vending machine, except you don't need to set it up, maintain it, or even plug it in. Gets Mine hosts your miner in professional-grade data centers and manages everything for you. You own the machine, and you get paid directly in Bitcoin. No custody, no lockup. You're fully in control. And here's the kicker. Right now, if you use the link in the description, you'll get exclusive access to a private deal. You only pay 60% for your new mining rig. That's not available anywhere else, and it won't last long. Now, why mining? And why now? Simple. Bitcoin is in an accumulation phase. This is when the smart money positions itself. Mining gives you consistent exposure to Bitcoin, and unlike just buying and waiting, you're generating income over time. In fact, based on average mining performance, you can potentially accumulate up to 242% more Bitcoin over 3 years compared to buying spot. That's a big deal. Gets mine handles. Fast deployment, within 24 to 48 hours. Energy-efficient hosting across multiple countries. A fixed rate of $0.065 per kilowatt hour, all inclusive. Near 99% uptime with full monitoring and remote support. You can track everything from your phone with their mobile app, earnings, hash rate, ROI, all in real time. This isn't cloud mining. You actually own the hardware, and all payouts go straight to your personal wallet. So if you're serious about stacking sats and want a smarter way to grow your holdings, now's the time to act. Use the link in the description, and you'll unlock an exclusive private deal. Pay just 60% for your new mining rig. It's fast, transparent, and completely hands-off. Don't wait until Bitcoin breaks out again. Start earning today.
What's your overall assessment of the market, where we are, and how do you anticipate the market in the second half and 2026?
Well, the stock market in 2025 faced a black swan because Tariff Liberation Day was a shock, and it created a downward spiral in stocks, falling 20% in the fastest pace, or one of the fastest pace in 100 years. There have only been 12 times in history that stocks fell a similar amount and a similar speed. And I think the mistake many people made was that shock turned people bearish. As you mentioned, we did think there would be a correction this year, but the reason I think we didn't turn bearish, even though this was a huge decline, is 3 things. One, we didn't expect President Trump to stick with the tariff terms. So even though in the beginning they claimed this was the deal and everyone had to take it, we thought they would eventually walk back those terms, which is what's happened. And in fact, what we've seen so far is the tariffs are much, much milder than many people thought at the start of the year. So we're actually in a better place. The second is many economists convinced you that there'd be a recession. Do you remember all these economists said a recession's guaranteed, and that's why everybody panicked and sold their stocks. But we don't necessarily listen to economists. We prefer to watch what the high yield market is doing. And the high yield market, while it showed some turbulence, actually moved in a way that said there might be a growth scare. So there's a difference between a growth scare and a recession. A growth scare just means everybody gets cautious, which is understandable. And the third reason we didn't turn bearish is that waterfall declines, like we saw, usually come back as a V-shaped recovery. And that was our argument, that this would be a V-shaped bounce. And in fact, we were pretty convinced of it because the VIX, which is a measure of volatility, jumped to 60. And if you look at the last 35 years, anytime the VIX has moved above 60, no matter what you think, you have to buy the stock market because that's pure terror. The market is so scared, they're not pricing anything, and that's why you have to buy that. And so stocks had a V-shaped bounce. And now that we're almost back to the old highs, I'm finding a lot of people are still bearish. Maybe in the audience, you guys are still bearish, thinking, I don't see why stocks came back, so I don't really want to buy the stock market now. But here's something to keep in mind. In 2025, we've already had a 20% decline. The chances of a 10% decline between now and year end is very low. It might even be statistically 0%. So maybe the stock market could trade sideways for a little bit, but the chances of us declining again are very low. The Fed is not cutting rates right now. And Fed Chair Powell said he's not cutting interest rates because he's expecting inflation to rise over the summer because of tariffs. That might kind of make sense. I mean, I'd say if someone said that to me, I'd say I understand that prices should be going up because of tariffs. But that is not actually how monetary policy should be administered. The Fed is really supposed to overlook supply shocks. So if you have a supply shock, like a tax, and it causes a one-time rise in price, the central bank is not supposed to adjust monetary policy for that, because the Fed is trying to control demand. Meaning, if there's so much demand for something that it causes prices to go up, they try to tighten monetary policy. But because of tariffs is more like a supply shock, the Fed should actually look through it. The bond market is starting to make that conclusion. On Wednesday's FOMC meeting, the bond market disagreed with the Fed. Interest rates actually went down in the last couple of days because they don't believe the Fed should be on hold. And that's also been our argument, that the Fed, if they're not cutting now, they have to do more cuts next year. Maybe more importantly, most people think stock rallies are only because the Fed is easing, adding liquidity. That's why in the April lows, people were saying the stock market couldn't rebound because the Fed wasn't going to add liquidity. But guess what? We had a V-shaped bounce anyways. And so it shows you the central bank isn't needed for stocks to rally, but next year we think they're going to cut a lot, and that should support stocks. And as far as positioning goes, I don't think you really explained our view on sectors this year. At the start of this year, our top calls were industrials, financials, and tech. That was first, second, and third. Year to date, industrials, financials are outperforming the market. And tech is actually beginning to outperform. So that's really been our stance this year. But with the Fed cutting rates next year, I think that's going to be good for interest sensitive. So that should really support financials, and it should support small and mid caps.
As Tom Lee explains, despite the panic we saw earlier this year, the U.S. stock market has proven remarkably resilient. Tariff shocks, economic doomsaying, and tightening fears didn't derail the long-term trajectory. In fact, Lee believes we're entering a window of opportunity, where the worst may already be behind us, and where both equity and crypto markets could benefit from easing financial conditions, cooling inflation, and a Federal Reserve that's likely to pivot more aggressively in 2026. But the conversation doesn't end with market cycles or monetary policy. Lee shifts the focus toward a more foundational concern, one that comes up again and again among investors: U.S. debt and the future of the dollar. It's a familiar refrain: the deficit is too high, borrowing is unsustainable, and America is nearing a tipping point. But as Lee points out, these warnings have echoed through Wall Street for decades, and yet the U.S. economy remains the most liquid, innovative, and globally dominant system on Earth. Lee's point is simple: fear over debt and deficit hasn't changed the fact that America still leads in global capital markets, innovation, and corporate scale. In fact, 21 of the world's 25 largest companies are still headquartered in the United States. Borrowing costs remain mysteriously low despite massive issuance, and the dollar continues to dominate as the world's reserve currency, not because the US is flawless, but because there's still no real alternative. Let's get back to the video.
How we should understand the physical situation and any potential risk here.
When you read the newspaper or you hear financial commentators, a lot of people tell you the U.S. is in trouble because of the deficit, and the U.S. has unsustainable debt. And that's true because we know the path for the U.S. debt is unsustainable. But here's the thing. When I started on Wall Street in the 90s, that's also what I heard on Wall Street. I remember our economists and our bond heads of fixed income saying the U.S. is on an unsustainable path for debt, and that was 35 5 years ago. So for the next 35 years, you're going to hear the same thing. The U.S. is on an unsustainable path of debt, yet it's probably not going to make a difference. That's my opinion. But I do agree that we're in a very strange world because the U.S. prints money and they print a lot of dollars, and yet the borrowing cost is really low. It's very mysterious to me, but I don't think today's levels represent any sort of break point. And here's a really simple way to think of it. One, dollars is the reason people have used, own bonds, right, and use the U.S. economy. And dollars are mostly used for speculation. For every dollar of GDP activity that we have, the dollar is traded in oil, bonds, equities 400 times. So as long as the U.S. is the most liquid economy in the world, we're going to print a lot of dollars and interest rates are going to stay low. And the second is that as much as you hear stories that say the U.S. is losing its importance, so the rest of the world is becoming more dominant, and that's why the U.S. is in trouble. One, again, I've heard that story for 35 years. Everyone's told me the U.S. exceptionalism has been over, and it yet has never ended. If you look at the 25 largest companies in the world, 21 of the 25 largest are in America. So just because U.S. borrowing costs might change, is Germany going to suddenly be the place where the next Mag 7 comes? Just because borrowing costs change in the U.S., will Germany suddenly be the next Silicon Valley? I mean, if you believe that, then you should bet against the U.S. I'm very skeptical of that. So I think you shouldn't make a portfolio decision thinking stocks are going to fall because someone told you the U.S. can't fund its deficit.
You did mention that you were one of the first on Wall Street to make a call on Bitcoin, but do you agree that Bitcoin, Ethereum, these cryptocurrencies will continue to do very well for the next couple of years?
Yeah, I mean, I think Bitcoin is, if you're buying Bitcoin today, it's still early. I don't think it's too late. So if you have zero exposure to Bitcoin and you feel like you missed it, 95% of investors have zero Bitcoin exposure. So you're still way ahead if you're buying Bitcoin today. If you look at Bitcoin wallets, comparing it to the internet, we're back to 1996 levels. Internet went exponential from 1996. So it's still the earliest days. I think Bitcoin is very useful because in the future, we're not going to be able to trust anything because cybersecurity, there's nothing secure anymore. We can sample your voice. I mean, even someone takes our voice, translates into Korean using my voice, you'll never know what's true anymore. So you need to be able to trust a system. The blockchain, the Bitcoin blockchain is the most trusted blockchain. And that's why the United States wants to have 1 million Bitcoin. US companies are buying Bitcoin. Banks will soon carry Bitcoin as collateral. But Ethereum is really important too. Did any of you buy the Circle IPO or own Circle? Circle is a stablecoin, and they just went public 10 days ago at $31. It's now $242.
What is the ticker code?
CRCL.
CLCL.
Circle is a stablecoin. It's the second largest. Stablecoins are being pushed by the United States government. Here's the thing. Circle runs on Ethereum. Stablecoins run on Ethereum. So as stablecoins explode, Ethereum is the backbone for stablecoins. So I think Ethereum is going to make a big comeback as well. So I think those two are useful. And then Solana I like, but it's not nearly as used as Ethereum.
Tom Lee's perspective on U.S. debt is refreshingly contrarian, not because he denies the math, but because he understands the system. He acknowledges that the debt is high and growing. He agrees the current path is unsustainable. But he also points out something most investors forget. People have been saying this for decades. In his words, when he started on Wall Street in the 1990s, economists were already ringing the alarm about U.S. deficits. 35 years later, the story hasn't changed, and yet the dollar remains dominant, interest rates remain relatively low, and America's corporate power continues to outpace the world. Lee believes that liquidity, institutional trust, and innovation, not just debt levels, define the future of global leadership. He argues that the US dollar isn't going away, and that while the system may be stretched, it's not near a breaking point. In his view, betting against the US economy is historically a losing trade, because the US keeps adapting, keeps growing, and keeps producing dominant companies that anchor the financial system. But not everyone agrees with that level of optimism. Lynn Alden, in her widely circulated essay, Nothing Stops This Train, outlines a more structural and arguably more sobering analysis of America's fiscal trajectory. She also recognizes the U.S.'s historical resilience, but her framework is built on the understanding that no fiat system can survive unchecked monetary expansion forever. She notes that the U.S. is now in the later stages of a long-term debt cycle, similar to what previous empires have faced, where interest expense, entitlement obligations, and social promises outpace tax revenue in perpetuity. In Alden's view, the Federal Reserve is increasingly boxed in. To prevent insolvency or social unrest, it must intervene in markets, either through direct monetization of debt or by suppressing interest rates artificially. But this comes at a cost: persistent inflation, declining real yields, and a slow erosion of faith in fiat. As she writes, "The train keeps moving, but the rails are bending. Nothing stops this train, but eventually it derails." Where Lee sees strength in U.S. liquidity and corporate dominance, Alden sees vulnerability in the long-term solvency of the system. Where Lee believes interest rates will stay low because of global demand for dollars, Alden argues that structurally high deficits will force central banks into a corner, creating a dangerous feedback loop of monetization and asset inflation. And that's where their views converge, not in diagnosis, but in the implications for Bitcoin and crypto. For Alden, Bitcoin is an exit ramp, a neutral monetary asset that cannot be printed, cannot be diluted, and operates outside the control of governments. It's not just a bet on tech, it's a bet against the credibility of central banks. For Lee, Bitcoin is equally important, but not because the US will collapse. Rather, because the world is moving toward digital trust layers, and blockchain is the infrastructure of the future. In both frameworks, crypto isn't a fad, it's a necessity. Lee also highlights Ethereum's role in powering stablecoins like Circle's USDC, which recently exploded in value after going public. These aren't speculative tokens anymore. They're payment rails, liquidity engines, and programmable dollars. And they run on Ethereum. Whether you lean more toward Alden's structural caution or Lee's strategic optimism, the conclusion is the same. Crypto is not just a hedge, it's the foundation for the next era of finance. But the bigger story, the story both Tom Lee and Lynn Alden ultimately point toward, is that trust is leaving the old system, and something new is being built to replace it. Bitcoin is the hedge, Ethereum is the infrastructure, and the adoption curve is still in its early chapters. If Tom Lee is right, we're not just early, we're ahead of the next great financial transformation. And if Lynn Alden is right, then owning assets outside the traditional system isn't just smart, it's essential. Either way, the message is clear. The future of money is being built right now. And drop a comment below. Whose outlook do you align with more? Tom Lee's pragmatic optimism or Lynn Alden's structural realism? If you found this analysis valuable, don't forget to like the video. It helps more people discover the truth behind the headlines. Subscribe for deeper dives into crypto, macro, and market psychology. Thanks for watching, and see you in the next one.